Hello, welcome back. In this video, we're going to be taking a level-headed approach to what is potentially going to happen this year with the stock market. Now, in order to understand what are the potential cases, what could happen, what are the possibilities, we need to kind of examine what has happened in the past. This can actually help indicate what could potentially happen in the future. It could tell us a few things about what the Fed will potentially be doing and kind of give us some hints about what is to happen this year. Of course, we can never know for sure, but we can get some very reliable information by examining what has happened in the past. And you can see here that I have this very nice chart which kind of describes major crashes that have happened for the S&P 500. And you will see here the amount of drop that we had with these crashes. Now, like for instance, that is the Great Crash, pretty much the depression that the US had, the Great Depression, where there was an 86% drop. This is an event that hasn't really been seen again since then. Hopefully we won't see it again. But back then it was a different era, and this lasted a lot. This was the Great Depression. It really devastated the US, and there has been a century since that happened, frankly. Now, after that, we have had drops of like 48%, 49%, as you'll see here, for instance, for the dot-com bubble, the global financial crisis with the US housing bubble, for example, that burst and collapsed, 57%. Black Monday over here, 29% drop, as you'll see. And this lasted 402 days, for instance. And the COVID-19 crash, remember that lasted about 117 days over here with a 34% loss amidst this kind of season. Now, what is expected for 2023? We have seen that the stock market has declined a lot this year, quite significantly so. You can kind of see it here in this chart. You have the history of what the stock market has been doing every year. This is since 1928 over here. And this basically includes the Great Depression as well, where the stock market went down like 87%. As you'll see, this was consecutive years of declines over here. And then there was another crash over here, 38%. Another big one over here, 1974. And some more over here in the 2000s, 2008, of course, everybody remembers that, about 40% of a decline. And today we're looking at about a 20% decline here in 2022. Now, of course, this depends on when the actual caption was taken. I think it's actually a little bit more right now. But you can kind of see that the stock market, for the most part, has been actually in the green, and it's just a few years in between that are, pretty much getting us some red over here, pretty much resetting some of the progress that the stock market has been making over the years. This is very normal. And you can kind of see here this very handy little PDF. Let me actually make it a little bit larger over here. You will see that the number of days where the stock market has had bear markets. Bear market is a market where the stock has been going down more than 20%. This is what we call a bear market. So this is how much it lasted and how much it went down for. So this one, again, this was like in the Great Depression era, 83%. Then we have had some 40%, 30%, 54%, 34 over here, anything above 20% over here. They tend to last, as you'll see here, about 200 days, maybe 250 in some situations. This is why we're saying that overall it tends to last about a year and a half. It's about 15 months, 18 months, something of that sort tends to be the average. Of course, there could be more days. It really depends. Sometimes it could last for more. Like, for instance, this was almost 1,000 days over here where the stock market went down 50%. And, the 2008 crash, 517 days. So it could last for 2 years in some situations. It could last even more in some situations, in some other situations. But for the most part, these kinds of bear markets tend to last about a year and a half to 2 years, I would say. So we're already about a year in, it looks like, during that crash, or maybe about a year in. So, in terms of the declines that you see here, these are the bigger ones. Pretty much, these are not representative of all of the bear markets, but these are some of the big ones that have happened. And in between of all these, there have been major corrections many times, like 15% corrections happen a lot in the stock market. You'll see that a lot. Now, very important thing to understand is the federal funds rate, which is basically what the Fed is basically directing where it's going to be getting at. The Federal Open Markets Committee, FOMC, this is the Fed pretty much, they set the federal funds rate. This is known as the federal fund rate's target rate pretty much, and the current rate is about 4.25 to 4.5, as you'll see here. And it's important to understand how this works. This is when customers deposit money at banks. These deposits that the customers deposit pretty much provide the banks with the liquidity, the capital that is needed for loans and other forms of credit. And regulators require that banks and other depository institutions keep a certain percentage of capital pretty much in their repositories pretty much to be able to guarantee the stability of the capital markets pretty much. And this amount actually basically fluctuates, and for this reason there are loans that are approved and repaid between banks, for example. As you'll see, banks often need to borrow money from other financial institutions overnight to meet regulators' reserve requirements, so they may end up with excess reserve capital. They shouldn't be having excess. It's important to lend out to their peers. They have to be within the limits. So the federal funds rate provides the reference pretty much for these institutions, that the amount of interest that they are paying and between borrowing and lending pretty much. And so, as this increases, you can understand this is like the base interest rate. It's like the core interest rate, and from there on, there are like other customers like you and I that are potentially buying this for getting loans, for example, for buying a home, mortgages, for instance, or in order to be, buying furniture, whatever, anything, a car or something of that sort. As you can understand, our rates are going to be higher than this. And so as these grow higher, our rates are going to be growing higher as well, are going to be getting adjusted as well. And so you can kind of see it here, for example, the 30-year fixed rate mortgage average in the United States has been going down, and then there has been an increase over here as the federal market, pretty much the federal funds rate is getting increased. And you will see here, again, we're looking at a similar story over here. That's the federal funds rate, pretty much since 1954. At some point, it was even 20%, as you'll see here, back in 1980. And then it has been going down and down. Remember, this was the 2008 crash, where there was a major crash in the markets. And then what did the Fed do? They actually dropped the rates, the federal funds rate. And for this reason, basically the economy got a spark because it was now much, much easier to borrow money. And this kept going for a while. Then it went higher, then dipped again, and then higher again, because we're having this insane amount of inflation that we're getting right now. And we're currently sitting at 4.2%, as you'll see, as I mentioned earlier. 4.2 to 4.5 is what we're currently seeing. So when will the Fed stop hiking rates? Now, as you'll see, they are looking at some point near 2023, potentially within 2023. But it is important to understand what this article is talking about here. Not when, but where is the important thing. Where are we done? Where the economy will go back to normal slowly but surely after we reach this peak. And it looks like the final target rates may be at about 5 to 5.25%, which is indicating that we need about maybe 75 to 100 basis points of increases before they start backing down, and seeing how this reflects back to the economy. It takes a little bit of time for the overall economy to catch up with these changes, and inflation to basically cool down. Normally it takes a few months of time, frankly. And it is important to understand, in case you are not aware, that the federal funds rate is a fantastic tool for the Fed to be able to cool down the economy or potentially spark the economy. And so as you'll see here, for instance, in 1980, you get this as an example, the Fed funds rate was very high. Again, I can show you, in this video, in this one over here, you'll see that it was very high, sitting at about 20%, which is absolutely bonkers. And the reason why we had double-digit inflation, so they needed to battle it. It's a similar case to today. Not as much as today, although it may actually be that much even today. It's concealed through different types of measurements today, potentially. It's more than likely higher, significantly even so, than what we're actually getting at today. And higher interest rates, what they did back then, they kept borrowing and spending. Understandably so, because it's more expensive to borrow money, and so people borrow less money, and so the economy cools down. And so the Fed fund rate is low in 2008, for example. Again, what I told to you about earlier, when we had pretty much the big crash back in 2008, where the Federal Reserve actually lowered the Fed funds rate to 0% to revive the economy during the recession, pretty much. Because when there is a recession, people stop buying and selling stuff. The economy pretty much goes on a pause it stalls. So in order to spark the economy, you need to have to actually give away free money, pretty much. So money that is very, very easy to borrow, and you don't pay a lot to borrow that money. So the interest rates are very low. In order to do that, you set the Fed funds rates at a very low rate, so that all the other consecutive types of lending and borrowing is going to be cheap as well. So this is what the Fed is effectively doing with setting their Fed funds rate. And so for this year, for 2023, what we are having right now is obviously we're having an economy that is very soft. I mean, we are coming out of a time where people were locked down at home, prices skyrocketed for this reason, and also the extra money that was printed without the productivity to back for that money. Because when you are actually printing all this money and nobody's working, so this, the current money gets a lower value. There's more of it, so the current money gets pretty much worthless, more worthless than it used to be. And so, in order for the economy to go back to normalcy, we need to have obviously the inflation levels going down, at least down to maybe 3%. We're currently sitting at like 7%. Maybe we're gonna go a little bit lower, 7.5 right now. And we do really need to see a decline. I do think we're likely to see a decline, but it really depends on what the governments are going to be doing. So if they're going to be locking down people again, if they're going to be printing more money and overspending and things of that sort, then we're going to be having more inflation on top of what we already have. So it really has to do with the policies of the governments as well. Very important. Because the Fed can only do as much. Like if they increase the rates and keep increasing the rates, but the government still prints money and still locks down people, we're going to be having even more inflation, despite the increases in interest rates. And so there has to be a combination there. But if that happens, and if we are on the expected path, pretty much, that's what should happen, then we're going to be looking at interest rates going down. And when interest rates going down, then the stock market picks up. It's very normal. Spending will become higher. Eventually, interest rates will be going down. It's going to be easier to get money, and companies will find it easier, basically, to do all their operations. They're not gonna be spending as much, and so it helps spark the economy. People are gonna be buying more lending means more activity in the economy, and so this is what we could potentially be seeing as we're approaching. I think maybe after the summer of 2023 is more than likely going to be sparking potentially, or maybe the end of 2023. In between this, we could be having some months that we're going to be looking at this kind of price action that we had in the previous year, where things were going down, because the economy is trying to adjust itself pretty much. And also, again, it really depends on what the governments are going to be doing. We're going to be here, we're going to be examining what is going to be happening, but I'm going to be definitely be making videos about the Fed and what they're going to be doing and what interest rates are doing. Super important for the upcoming year. This is really going to dictate what the overall stock market is going to be doing. Very normal. But thank you for watching this video. I hope you learned something here and it helped you. If it did, please leave a like, that helps a ton. And remember to subscribe if you are new around here. I'll see you in the next video. Bye bye for now.